Hello, my name is Jonathan Alexander, and this is Business 604 Fundamentals of Business Analysis. Now, today I'll go over sensitivity analysis for capital budgeting. We'll start off with what is a sensitivity analysis? This analysis involving changing the assumptions or estimates in a calculation to see the impact on the projects. It is a useful model to show how dependent the output value is on other inputs. It gives the idea how much room a variable to go adverse in assessing the risk. Sensitivity analysis refers to how sensitive the result of a capital budget technique is to variables that say discount rates while keeping other variables constant. The purpose of the analysis is to identify critical variables and increase the understanding of the risk associated with a project. It is a way assessing relative importance of each variable while giving respect to the other variables. How we conduct a sensitivity analysis. First, the base, for example, the NPV, also known as the net present value, is at the base case value of the input, which we intend to measure sensitivity, such as discount rate. We keep all other inputs in the model, such as the cash flow growth rate, the tax rate, or the depreciation constant. We will also find the value of the output at a new value of the input, and we'll know this as the V2 rate, while keeping other inputs constant. What we do is find the percentage change in the output and the percentage change in the input. We find the sensitivity by dividing the percentage change in output by percentage change in input. What is capital budgeting and how this relates to sensitivity analysis? It is the process that companies use for making decisions on capital projects. They look for these that have a year or more in growth. Behind the capital budgeting is the cash flows that go into the model and several extensions of the basic model. It's a way of organized analysis, a way of increasing understanding and insight into a project situation. It determines the relative of each variable. It also is a way of deciding which variables to concentrate on and increasing the understanding of the situation. It's the process the business undertakes for potential major projects, such as build a new building or a new wing, whatever the company is looking for. Projects that will require capital budget before they are approved or rejected. Now let's take a look at the qualitative steps for sensitivity analysis and identifying the full range of risk and the description of the risk. Right now, we're looking at a global financial crisis due to COVID, due to other major forces that have happened in our current world. These all play a role into deciding which investments to look into and which projects seem less riskier. Understanding the risks that are going to be taken on a qualitative view is important because it leads to the quantitative view. Now let's take a look at the quantitative steps for sensitivity analysis. You have the risk calculation, you have the risk assessment, and you have to understand how to minimize the risk. The sensitivity analysis shows what extent the viability of a project is. It's influenced by its major quantifiable variables. Investors are looking for ways to make a profit off their investments. They are calculating the risk of how much money needs to go into for what profit they're going to make. And they also need to understand if that does not work out, what profit loss are they going to take. This is very important, and the sensitivity analysis puts it in perspective for using the variables of the input and the output. We're going to finish off today with project risk, understanding how they're in the portfolio management and consideration for project financing decisions, and how the returns are affected by sales, investments, tax rates, and the cost of sales. Understand that the capital budget itself is a plan for investing in long-term assets, i.e. buildings and machinery. You have to understand risks are inevitable. Investors are always trying to avoid risk, but how do you get them to invest in more riskier? You have to ensure that the returns are greater than the less riskier ones, because if you want to make a good return, you have to risk a little bit more, but that risk has to be worth the consideration and not avoided. Today, the references I used were sensitivity analysis. I also studied capital budgeting And what is capital budgeting? And what types of projects appraisals and methodologies small businesses use? Thank you for listening. Have a great day.